We're going to talk a little bit about bonds. And this is important because today the Federal Reserve, Jerome Powell, will be speaking before the Senate committee. Tomorrow he will speak before the House. And a lot of the focus is on interest rates. Obviously, you see that interest rates are currently, we just had a 75 basis point hike. We're expecting another 75 basis points in the Fed funds rate. That Fed funds rate is what impacts all lending across the United States. So whether you have a car payment, if you have a house payment, if you have any other credit that is variable, not fixed, it will be impacted right now by the Fed's fund rate. And if you're taking out new loans, it will be impacted by this rate. But lost in the discussion is the Fed's balance sheet. And the Fed's balance sheet is $9 trillion. The Fed owns 25% of all bonds in the U.S. markets. And they did this because of the crisis that started not in 2008, but actually going all the way back to 2002 when we had the dot-com bubble. But in 2009, they started what is known as quantitative easing, where they started buying bonds and mortgage-backed securities in order to provide money to the market. Don't worry about support. I'm talking about money, also known as liquidity. They provide this capital in order to bury some holes, cover some holes, paper over some debt, ensure that the markets are stable, but also to provide capital to the market in order for it to function properly. And as you can see, this balance sheet increased very, very, very sharply all the way up to about $4.5 trillion into 2017. Then in 2018, the Fed began to sell these assets back into the market. They were taking liquidity out of the market. And this matters because it created a significant amount of volatility in 2018. After that massive bull market that we saw from 2009 up to 2017, this was the first year that we were down in the markets. We were down 6.5% that year. And when the Fed ratcheted up it's selling from $30 billion during this period to $50 billion, you saw Armageddon at the end of 2018. The Dow or the S&P 500 fell by 19.8% in December 2018. Now, why does that matter? It matters because the Federal Reserve, through what is known as open market operations. Open market operations are what they do in order to provide support to the economy. They either raise or lower interest rates. You raise interest rates to cool the economy down. You lower interest rates in order to provide lower borrowing costs in the hope to spur growth. But they also have the balance sheet. And the balance sheet, they either buy bonds to provide capital to the markets, or they sell bonds, thereby draining it from the markets. Typically, open market operations happen on Wednesdays, and the Fed began its quantitative tightening this month. They are set to take out or sell $47.5 billion in bonds this month. They haven't done anything the first 3 Wednesdays, so the expectation is they're going to either do it today or they're going to have to kick it all the way to next Wednesday. But $47.5 billion per month moving up into September, when they are saying they are going to go to $95 billion for the month of September. I fully anticipate that we will see a recreation of this, where as we move through the summer into August and September, with the Fed draining liquidity from the market, far more volatility, far more downside to this market. Not a lot of people talking about quantitative tightening because there is not a significant amount of data out there to show what happens, but we have seen 2018 what occurred. So be very, very cautious. Momentum remains negative this morning. You will get an email explaining what's going on with momentum. Sign up at middaymomentum.com to get that email every single day. And be cautious right now. This is a day trader's market. You want to be able to follow me to know what the Fed is doing, when the Fed is selling. I will provide an update on that tomorrow in the morning momentum letter.